this topic actually kind of popped into my head several weeks ago after I was working with somebody out of UACI's one of the portfolio companies, because we're looking at some tax amendments at this point, and that's made me start thinking about this particular topic. And so I reached out and said, hey, I think I'd like to present this. I think it could be helpful. So thanks everybody for joining today. And we will get started. So the business and tax considerations when you select your entity, there's a couple of different things to think about that maybe you know or don't know at this point. There's actually a difference between what the IRS recognizes as a taxable entity compared to what your choices are as a business entity. And so right now, what is recognized by the IRS is a sole proprietorship, a partnership, a corporation, and then another type of corporation called an S corporation. And those are considered taxable entities. Now, most folks are limited liability companies. And you might notice limited liability company was not in the list for recognized by IRS. So that business structure, the limited liability company, is something that is allowed by state statute. All the states in the US allow that. And so a lot of times when we talk about what is our entity structure, we'll hear our LLC, or we'll hear LLC partnership, or LLC corp. Or like if I'm in a conversation with you and you're talking to me about your LLC, I will ask you exactly what kind of LLC you have, because I need to understand what your taxable entity is. So when you are going to select that, you want to be sure that you're thinking through what are the legal and tax considerations. So the IRS looks at these entities as they have two parts to them. Are they tax reporting and are they tax paying? And a single member LLC is taxed as a sole proprietorship. So if you think back to the first slide we looked at, sole proprietorship was one of the taxable entities. And in this, a couple of things about this, owner does not take W-2 wages. It's a pass-through entity, which means that the data or the results of your activity are reported into your 1040 personal individual tax return. So the single member LLC is not a tax reporting entity, and it's not a tax paying entity. And important around the tax reporting entity piece is that tax reporting by the owner is on the Schedule C, which is business income, and that is included in your personal tax return. And also the owner is going to pay self-employment tax. And so that means you're going to pay both, like if you were in a corporate environment, right, the company matches your Medicare and FICA tax. Well, in this world, you pay both out of your pay, or you pay both out of your income that you've earned from the business. And so you're paying like 15.4%, I think is what it's around when it's doubled up. If you are a multi-member LLC, then your tax is a partnership. So remember, partnership was a taxable entity. Partners do not take W-2 wages. It's also a pass-through entity. It's a little unique as far as self-employment tax. A general partner will pay a self-employment tax on the income that's reported into their K-1. Limited partners will only pay a self-employment tax if they receive guaranteed payments for services provided to the partnership. It is a tax reporting entity, which is done on a 1065 partnership tax return. It's not a tax-paying entity. So the tax is paid by each owner when they file their Form 1040 and they attach their K-1. And a K1 is the partner's share of income deductions and credits. So it basically summarizes everything that transacted in your business in those major categories. And then that pops into a line on your K1 or on your 1040. So if you choose to be taxed as an S Corp, you again are a pass-through entity, and an officer must take a W-2 wage. You are a tax reporting entity, and you do your tax reporting on the 1120S U.S. income tax return for S Corporation. You are not a tax-paying entity. So this one, because it's a pass-through, tax is going to be paid by the owner when they file their 1040, and they attach their K1 shareholders' share of income deductions and credits. So when the tax preparation part is happening in these entities that have K1 reporting requirements, the K1s are part of that process when the tax return is prepared. What if you want to be a C Corp? It is a tax reporting entity and it is a tax paying entity. So there's nothing to do with the individual in this case. The shareholders are not responsible for anything as far as liabilities of the company, and the company is a standalone and separate entity from the individuals who are the owners, who are known as shareholders.
Jody, can I pop a question in real quick?
Yes.
Ashok asked, would these entities still comply with other tax obligations such as sales tax, et cetera? And I'm guessing which entity were you referring to, Ashok?
LLC.
Yes. Yes. Everybody. So your business structure, one of these organizations, because if let's take a step back, right? We're talking about our business structure versus our tax requirements. And so in your individual states, you know, the LLC is recognized as a company, and that's the states that actually attach those sales tax requirements to the LLC. Good question. Thank you.
But they can have employees, right? Once you have employees, then you have to report. Even then, you report the tax as what? Right?
The LLC, yes, LLCs can have employees. You just don't pay as an owner. You don't treat yourself as an employee.
Okay.
All right. Let's move into entity considerations. So, for the sole proprietorship, we know that, and then the flip side of the business type term is the LLC single member. It's the default entity. So whenever you start filing to like be a business, that's the default. So you want to make sure that you're thinking through all this stuff and you actually make an entity selection. Otherwise, that is your default. It's not really a good choice for most businesses. It is the simplest form. You own the business, you control its management, you have all the rights to profits and losses. The taxation, again, goes directly through to your personal individual return. It is simple and inexpensive. Again, the owner controls everything, and you only have that one layer of tax that happens on the individual person's tax return. So the big disadvantage is that you have unlimited personal liability. So there is no separation between you and the business. You are considered the legal entity in terms of being the sole proprietor. And so that's really the huge disadvantage to being a sole proprietor. These entities are not used to raise money. They've only got one owner by definition. You don't have the ability to do any sort of equity compensation because you're not organized like a C Corp where you're actually like issuing shares to investors or maintaining a pool for an employee incentive plan.
Jody,
and
can I jump? Oh,
yes,
I jump in with another question. I just don't want to get too far ahead and then
Sure.
be off topic. But Shruti asks, an LLC taxes an S corp still looks like LLC, except that an officer draws a salary. Is there a difference?
so yeah, so it's more advantageous to be an S corp because your FICA is capped at $7,000 when you are taxed as an S corp. If you were to be an LLC, just a regular LLC, your entire income amount that's reported out on your Schedule C is, or your entire net income amount is subject to the FICA, but there's no threshold. So, you know, depending upon, you know, how well that business did, your let's say that the threshold right now for FICA is 7%. So on $100,000, that's going to give you the $7,000. But let's say in your
what is
LLC,
FICA? Sorry. What is FICA?
FICA, it's your Medicare tax and your Social Security tax.
Oh.
Yeah, so a general term, but and it's actually so the limitation is actually on Medicare tax. And so in your LLC, if you were just a regular LLC, and let's say you did $200,000, all $200,000 is going to have that percentage applied to it for self-employment tax. Whereas in an S corp, you would have a limitation so that you paid no more than $7,000. So that's a really good question and a very important decision point. I think.
So S corp is one step below C corp, but it's above LLC, right? So in the S corp, do you still say? I think in LLC, all the profits that you have, it gets passed on to, not the revenue, right? All the profits.
Mm-hmm.
In S corp, not all the profits get. The owner chooses how much profit to pass on to him and to keep in the company. No.
And an LLC S corp is still a pass-through entity, exactly like an LLC, and so 100% of the bottom line, let's say the net income, goes into your income lines in your 1040.
Oh, okay.
So, but if you are, you know, an owner who's a working owner and you want to draw a salary, like in the LLC side, you would not draw a salary and you would pay that self-employment tax that we talked about, and you would not have a limitation on how much you paid based upon your income. In an S corp, because you're taking W-2 wages, you will have a limitation on you know, you'll pay out to the max depending upon how much, you know, money it is that you're taking in the salary. But you protect the rest of you protect your actual bottom line net income from any additional self-employment tax for the Medicare beyond that $7,000 threshold.
Okay. All right, still trying to digest.
Okay. Yeah, it's a lot to take in. Let's see, we're on partnerships. So, you know, partnerships are, you know, more than one person, of course. Best to always use a partnership agreement when you do this sort of organization. If you don't have everything written down in an agreement, then, you know, that just creates chaos later when there is, you know, differing opinions on what should happen around the business. So really critical piece. It is surprising how many times you will meet people that didn't use an agreement, and then, you know, they're really stuck trying to, like, you know, war things out basically. But and you can put just about anything in your partnership agreement. So if you have like nuances that are beyond like traditional considerations, you know, you can put that in that agreement, and then, you know, basically there you go. It's written in stone. Everybody understands and lives by that. You do fund this with capital contributions, which means your partners are contributing their own personal funds into the partnership. Partners participate in the profits and losses. So again, they'll get that through their K1s. Decision-making of the partnership generally should be spelled out in your partnership agreement. Otherwise, again, you'll end up having, issues. The dissolution and the winding up is another key paragraph that will be in your partnership agreement. The taxation we talked through, it's a pass-through entity. When you think about, well, what's the advantage? Like as compared to a corporation, there's no double taxation. And we'll talk about what double taxation is when we get to the C corporation. And then a pretty flexible management structure, which is important again when in comparison to like a corporation, which has a very complex structure and generally not very flexible. The disadvantages of a partnership is that each partner has unlimited liability for the debts and the obligations of the partnership. And then transferring your partnership interest can be difficult.
Jody, I had 2 more questions.
Okay.
Shruti asked again, when do we choose to be taxed as LLCs, S Corp filing taxes?
So as soon as you have filed, as soon as you go into business, you should make that tax election, in my opinion. And it is possible that like you might start up the business as an LLC for a couple of years and then decide that you want to become an S corporation. And that's okay. Just, really be aware that you have that personal liability up until you become an S corp. And it's easily done with Form 8832. And you need to file that at least by March of the current tax year if you want the current tax year to be treated as an S Corp election or a C Corp election. And any of the LLCs except for the sole proprietorship, those can all select S Corp or C Corp. So the partnership can also can choose to be taxed as an S Corp or a C Corp.
Great. And then Terry asked, under what condition did the primary home become protected from liability?
Would say, does that mean that like you're working out of your home and you don't want to lose your home because of something going on with the business?
Terry, you're welcome to take yourself off mute if you want to go into a little bit more detail.
Sure, I just have to dash for meeting at 1. But yeah, no, I thought you said something about personal home being exempted from liability, but I didn't catch the context.
Oh, no. And
okay,
if no, I did not say that.
So for all of them, basically your personal liability extends to the point where your personal home is among the assets that could be at risk.
Yes,
Okay.
that's an accurate statement. Very good.
All right, thank you so much. Appreciate that.
Okay, so now let's see. What's the last one is the corporation. So the thing that's really attractive about the corporation is that it's a separate legal entity, very distinct from its owners and its management. It's the most common type of a business entity, and the owners are shareholders. The shareholders elect the board of directors. The board of directors appoints the officers to manage the day-to-day operations. You can have a single, you can have a single person shareholder in a C corporation or an S corporation in Arizona. Like if you ever got to the place where you're like, I really do need that C corporation protection. One thing that's interesting, shareholders are shielded from liability to the corporation. However, corporate officers could be held personally liable for unpaid taxes or unpaid wages. And that actually is imposed by the Federal Labor Standards Act. Not many people know that. So just something to be aware of there. And then another unique thing about corporations is that you have to avoid piercing the corporate veil, which means that you don't want to do anything that would lead the court to decide that you really aren't a corporation. And so all of the shareholders are responsible individuals. And there's actually a list of 5 like red flags. And the easiest one to, the easiest one to perhaps overlook and jump up and bite you and cause this piercing of the corporate veil would be following the formalities. So with, for a corporation, like you have to file an annual report with the Secretary of State. You have to have at least 1 meeting of the board of directors each year. And you need to keep minutes of those meetings. So there's those particular requirements when you're a corporation. Now, as an S corporation, just as an aside, you do need to file an annual report also and follow holding an annual meeting and maintaining your minutes. The others, like a partnership, doesn't have those rules, and a sole proprietorship doesn't have those rules. The governance, requires an articles of incorporation. You generally have a bylaws, which might be the same thing. It covers the types of things that you would see like in a partnership agreement for a partnership. And then shareholders agreements, which those are really important. Most folks are not going to buy into your corporation and invest money with you if they don't get a shareholders agreement. So I don't think it is very common that you wouldn't have that, but it's really an important document. It identifies your rights, duties, and responsibilities as a shareholder, and kind of handle, it's basically the same thing around making sure everything is figured out and decided so that there's no complications in terms of future events. The advantages, the limited liability for the shareholders, investors. C Corps are key if you're going out to do fundraising from investors. Investors are used to this vehicle for investing. It is considered an efficient format for raising capital. And you do have the opportunity for multiple capital structures. So you can do preferred stock, common stock, you can have multiple rounds. This is different from an S Corp, an LLC S Corp, in that an LLC S Corp can only have 1 class of stock.
And what that is, which class is that? Preferred or just 1 class? Nothing.
So multiple classes would be like if you had preferred stock and if you had common stock, and you could have, common stock A and common stock B. So it just aligns up with like what kind of rights do you assign to those stock classes? Because you could have, participation in revenue sharing could be something that you assign to a class of stock that would be different than maybe another class of stock who wasn't entitled to revenue sharing. And then the other thing the other thing that's really nice about a corporation is that you can use equity as compensation. And that ends up being pretty important for startups when they are going to be going out to do fundraising, and they need somebody on board to actually manage that fundraising, because that's not an easy job at all. And a lot of times you will see like whoever gets lined up to do that fundraising, if it's the CEO or if it's, some other title, equity will be used as that compensation in the beginning because the startup.
So it's the same as sweat equity, right?
Yes, that's another common one for it.
So S Corp doesn't have that, right? S Corp, S Corp also has shareholders, right?
Yes, S Corp does have shareholders. They only have 1 type of stock You typically do not see equity compensation in S corps. And that's a good question. Like I want to check that and just verify if it would be allowable. So I'll make sure I share that information with Amanda.
Because they also issue shareholding to employees, right? S corp can also do that.
You can have shareholders be employees, yes. Okay, and then as far as disadvantages, everybody, I think lots of folks understand double taxation. So that's why people always say, well, corporations are bad because of double taxation. And I always think that, rather than think about the taxation issue, think about the protection issue. Like, do you want to be sure that you are protected from any sort of personal liability? I think that is really the main reason to be a corporation. But the double taxation means that the net income of the corporation is going to be, taxed subject to the corporate tax rate. But then any dividends that you were to issue to shareholders, the shareholder is going to pay their personal tax rate on those dividends. And then, the governance system, pretty, relatively complex and not a lot of flexibility that way in terms of like, what does a typical corporate company look like? Okay, I think that's everything. The document was mailed to Amanda, and so there's a couple of other items in here that are in the appendix. Just a couple of tables that give you like the highlights of the IRS recognized entities, and then also just a little bit of extract around what the corporate veil as far as corporate formalities that we mentioned. So that's everything. Can you take more questions today?
Thanks, Jody.
Yeah,
and we'll get that out, but go ahead.
Hi, Jody. So you often hear that investors prefer, a C Corp over an LLC structure.
Mm-hmm.
Can you talk about that a little bit?
So that is really kind of boils down to the protection of, oh no, what did I do?
It just looks like the presentation just came off, but.
Oh, okay. But you guys still hear me at least?
Yeah, I can hear you.
Yeah.
Okay. So yes. So because the shareholders are not held personally liable, and the definition of the corporation is that the entity is separate from the owners, that is the primary reason that investors will invest in a C Corp versus any other kind of organization.
So if you're an LLC and you're out there looking for investors, it behooves you to change that to a C Corp.
Yes. And a lot of times entities will start out, as whatever version of LLC they are. But when, once they've gotten the traction to the place where they are ready to say, I'm going to go out and start fundraising, they will make that switch to the C Corp. Or, and this is interesting, at least in my stable of clients, I have clients who are involved in getting, the STTR grants and the SBIR grants. And so we have our LLC, and we've got that revenue source coming into those LLCs. And once we figured out, okay, now we're ready to start that investing search, then we create a new entity, which is a corporation, and that we end up doing a transaction so that the corporation owns the LLC 100%. And by doing that, we're able to not interrupt the business transactions with the federal government related to the grants. And so the grants can continue to feed into the LLC without any kind of hassle and change of paperwork or change of company names. And then we have then the ability on the corporation side to do the fundraising and solicit our investors without interrupting our grant funded activities in the LLC.
Sounds like a good strategy.
It's worked out.
And
It's worked
also,
out.
isn't it true that, see, in LLC, the investors can't come because it's a pass-through, right?
Right.
And the investors don't want it to be going into their, and they don't want to be a partner, right?
Right. So the investor option, if you were to do any other entity, would be partnership, which they don't want to do that because,
Correct.
they take on, the personal liability. Plus then they also pay 100% or they get their share of partnership and they pay self-employment tax on 100% of whatever is passed over to them. Same thing with the S corp.